Learning outcomes. After studying this module, you shall be able to know about the financial markets and their subdivision, learn types of methods of raising funds in financial markets, learn the statutory requirements of going public, learn the methods of pricing under initial public offer and process of book building, know what is the difference between two pricing methods, book building and fixed price methods, and allocation of shares. Analyze the role of SEBI as the regulator of financial markets. Introduction. Financial markets act as intermediaries among those who have surplus funds and those who demand the funds. Investable funds are available from saving surplus economic units such as households, business, or a government. Financial markets can be divided into two segments depending on the maturities of the financial instruments traded therein. Money markets. The term money market refers to a market in which short-term financial instruments are traded. Money markets facilitate the flow of short-term funds which have claims with maturities of less than 1 year. Thus, the borrowers are assured about the availability of short-term funds. Capital markets. Capital market deals in financial instruments which have maturities of more than 1 year. These are typically expected to generate a higher annualized return to investors because of their long-term commitment. Capital markets utilize the following channels to make savings available for investments in business entities. A. Internal savings of companies. B. Increase in entrepreneurial resources within bracket promoter shares. C. Direct purchase of financial securities through IPOs. D. Loans and investments made by intermediary financial institutions such as banks, insurance companies, and investments, trusts, etc. Capital market provides long-term resources which help in the long-term growth of the economy. These of the economies which developed their capital markets earlier has seen phenomenal growth of their economies because of the availability of funds through the capital markets. Capital market has two segments. 1. Primary capital market. 2. Secondary capital market. The primary market deals with the issuance of new securities such as shares and bonds. The process of floating new issues to investors is called initial public offer, IPO, and the market is called new issue market, NIM. Methods of raising funds in the primary market. 1. Public offer, IPO. 2. Private placements. Public offer can be 1. Initial public offer, IPO. 2. Rights issue for existing companies. And 3. Follow-on public offer, FPO. In this market, new issues of equity, new issues of equity or debt are arranged in the form of an entirely new flotation called initial public offerings. IPO can be from new company or existing company. Corporate can make an offer to the existing shareholders also, which is known as rights offering. However, if an existing corporate which had accessed the capital market earlier and wants to offer more equity to public, it is known as follow-on public offer, FPO. When the offer for shares is made to a select institutions or individuals rather than public in general, it is known as private placement. Funds can be obtained by the companies, governments, or public sector institutions through the sale of a new stock or bond issue. This is mostly done with the help of merchant bankers who provide all the services including underwriting facilities. Features of primary market are: 1. The securities are being offered to public for the first time. Therefore, it is also called New Issue Market (NIM). 2. Company directly issues securities to investors. 3. Money raised from primary issues are generally used for setting up new business or their expansion. Sometimes money is also required for working capital purposes or for retiring the debt or taking over another company. 4. The primary market assists mobilization of capital from the savers and therefore helps in the economic growth of a country. Methods of raising funds. Initial public offering, IPO. An initial public offer, IPO, means offering, selling shares of a company for the first time to the investing public. These shares are issued for the first time either already owned by the promoters, known as offer for sale, or fresh issuance by the company, known as public issue. Offer for sale does not increase the paid up capital of the company, whereas public issue of new share does increase the capital of company. This initial public offering can be made through: 1. The fixed price method, 2. book building method, 3. fixed price as well as book building method. Follow-on public offer, FPO. Follow-on offer is popular method for the companies that are already listed on stock exchange to issue additional shares to investors. FPO should not be confused with IPOs, as FPOs are supplementary issues made after the company has been already listed on an exchange. Rights offerings. Existing shareholders of a company have a preemptive right. Right offering is the issue of additional equity to existing shareholders of the company, which is issued on the basis of their existing shareholding. In case of right offer, subscription to the new shares is not open to everyone, but is confined only to those who already own the shares of the company. However, if the existing shareholders do not want to subscribe to additional shares, the offer can be renounced in favor of somebody who is interested in buying these shares. In case of right offers in profit-making companies, this renunciation can earn the existing shareholders some premium, which depends on the differential between the offer price and the market price of the company. Private placement. When the shares are offered to selected group of investors, it is said to have privately been placed. It is opposite of a public offering where the offer is made to public in journal. Investors in privately placed securities include insurance companies, pension funds, mezzanine funds, mutual funds, and trusts or select individuals. Securities issued as private placements include debt, equity, and hybrid securities like convertible bonds. Private placement is generally undertaken when the company does not want to wait for the long process and procedures required in case of a public issue, or when the capital markets are not booming. Requirements for going public. Process of IPO in India. Going public. When a security is listed for purchase or sale, that is trading on any stock exchange, it is considered to be publicly traded. This starts when a company needs additional capital to expand its business. It will sometimes choose to sell an ownership stake to outside investors. This process is referred to as going public. The process involves 1. Registration of draft prospectus, 2. Fulfillment of norms, 3. Appointments to the issue management agencies like merchant bankers, 4. Marketing of the issue. Registration of the offer document. Any company or listed company going for fresh issue or right issue of value more than 50 lakhs has to mandatorily file draft prospectus with SEBI. An offer document filed with SEBI before it is filed with the Registrar of Companies, ROCs, and is known as draft prospectus. Draft offer document is a public document that is made available on SEBI's website. Fulfillment of norms for the issuance of a public issue. Entry Norm 1. Profitability route. The issuer company shall have to meet the following requirements. A. The company should have in each of the preceding 3 years at least 3 crores of net tangible assets. B. Distributable profits in at least 3 of the immediately preceding 5 years. C. Issuer company should have at least rupees 1 crore net worth in each of the preceding 3 years. In the event of changing name by the company, at least 50% of revenues should be from the activity by the new name in the preceding 1 year. E. The issue size does not exceed 5 times the pre-issue net worth as per the balance sheet of the last financial year. In order to provide flexibility to companies, SEBI has given 2 more alternative routes to the company for the public issue. That is, after satisfying the conditions in entry norms 2 or 3. Entry norm 2, QIB route. In case the company fails to meet above requirement of entry norm 1, company can follow QIB route wherein issue should be through book building with 50% to be allotted to qualified investors. Rupees 10 crores shall be the minimum post-issue face value. Entry norm 3, appraisal route. A. At least 15% participation in the project by financial institutions or scheduled commercial banks. Apart from the above criteria, the issuer company should have at least 1,000 allottees in the above issue. These norms do not apply to private sector banks, public sector and an infrastructure company, which are exempted from the entry norms subject to certain conditions. Other mandatory norms: minimum promoter's contribution and lock-in period. In case of unlisted issuer, the promoter shall contribute not less than 20% of the post-issue capital that will be freezed for 3 years. In case of follow-up public offer, FPO, promoters are required to contribute not less than 20% of the post-issue capital. This ensures the minimum stake a promoter can have in the company. Source: SEBI website. IPO grading. IPO grading is the method of grading IPO or convertible securities by a credit rating agency registered with SEBI. The grade represents how strong it is fundamentally as compared to other securities. Disclosure of IPO grades so obtained was voluntary for companies coming out with an IPO till December 2013, whereas it was made mandatory. 3. Appointments of issue servicing agencies. The company shall make following appointments: A. Merchant banker and underwriter. B. Registrar for the issue. C. banker for the issue. D. Broker for the issue. A. Merchant banker and underwriter to the issue. A merchant banker is an intermediary specialist advising the issuer company to raise finance from the capital market. A merchant banker should have valid registration with SEBI to be eligible for appointment. A merchant banker is the one who is engaged in the issue management, either by making arrangements regarding selling, buying, or subscribing to securities. In order to sell its share to the public, company needs the services of a merchant banker to underwrite the issue. The role of the underwriter is to act as guarantor for subscribing to the issue if the public issue does not evoke enthusiastic response. Underwriting involves commitment to subscribe to the shares of a company to the extent it remains undersubscribed by the public. For this, underwriter charges commission. The issue, if small in size, can be underwritten by a single merchant banker. In case of a big size of the issue, the responsibility of underwriting is assigned to a group of underwriters known as syndicate underwriters. B. Registrar to the issue. The registrar provides administrative support to the issue process of keeping the records of shareholding. C. Bankers to the issue. Any scheduled bank having valid registration with SEBI can be appointed as the banker to the issue. There could be any number of bankers and there is no restriction on the number of bankers specified by SEBI. The main function of the banker involves collection of applications along with application money, maintaining daily report of the same, and forwarding money to the company. D. Broker to the issue. Any member of a recognized stock exchange can become broker to the issue. A broker offers marketing support, disseminates information to the investors about the issue. Nowadays, broker help in uploading the information in case of book building method of issuance of shares. 4. Marketing of the issue. Marketing of issue involves an attempt to increase retail distribution of the shares through network of brokers and roadshows by issuing company. Roadshows involve the investors or press conferences which are attended by high net worth individuals and brokers and press. These press conferences help the company seek the publicity of the proposed public issue. Post-issue activities. After the closure of the subscription list, the merchant banker should inform the issuer company whether 90% of the amount has been subscribed or not. If not, this is known as undersubscription and the underwriters should bring the shortfall amount. In case of oversubscription, the shares shall be allotted on pro rata basis and the excess amount shall be refunded to shareholders with interest. Nowadays, the public is made under ASBA wherein only the funds from the amount deposited by the applicant against allotment shall be utilized. Therefore, the problem of funds being stuck with the bank for a long time does not arise. The final prospectus. Before the final prospectus is issued, the issuer company makes changes in the draft prospectus and adds such important information as the offering price and the underwriting commission. The final prospectus must contain description of the offering, history of the business, description of management, price, date, selling discount to retail investors, use of proceeds, description of the underwriting, financial information, risk to buyers, legal opinion regarding the formation of the company. Listing of securities. Listing means that the securities have been included in the list of securities that may be traded at a stock exchange. The securities may be of any public limited company, central or state government, quasi-governmental and other financial institutions, corporations, municipalities, etc. Reasons for listing. The main reason for listing is to provide the exit route to the investors buying the shares in the primary markets. It also helps in spreading the risk of ownership among large group of investors, shareholders. When the company trades on the stock exchange, it provides liquidity to the existing shareholders. Listing could be a lucrative offer for the existing shareholders too, as it might increase the value of their shareholdings in form of capital gains if the price of the share goes above the issue price. A company can issue rights share through rights issue whenever company needs extra capital for expansion. It will be possible if the shares are already listed. This prevents the company from indulging any debt through debentures or long-term loan. Minimum listing requirements for new companies. Eligibility criteria for IPOs/FPOs. Below are the eligibility criteria for listing of shares of companies in India. A. The company must have a minimum issue size of rupees 10 crores and market capitalization of not less than rupees 25 crores. In respect of small cap companies, the minimum post-issue paid-up capital of the company shall be rupees 3 crores and the minimum issue size shall be rupees 3 crores and the minimum market capitalization of the company shall be rupees 5 crores. The minimum income/turnover of the company should be rupees 3 crores in each of the preceding 3 12 months period. And the minimum number of public shareholders after the issue shall be 1000. Source: BSE website. Market capitalization shall be calculated by multiplying the post-issue paid-up number of equity shares with the issue price. Permission. Before filing the prospectus with the ROC, company is required to obtain prior permission from exchange at which it is interested to list the securities. In order to evaluate the promoters, project in which company is funding capital and several other factors, Stock Exchange has formed a listing committee to analyze the draft prospectus/offer documents of the companies. Company has to submit its application for listing to stock exchanges in which it wishes to list its securities. Allotment of securities. A company is required to complete allotment procedure within 30 days of the date of closure of the subscription list and approach the regional stock exchange that is nearest to the company in case of fixed price method. In case of fixed price method of allotment, company is required to get the approval of basis of allotment. In case of book building issue, allotment shall be done within 15 days from the closure of the issue, failing which interest at the rate of 15% shall be paid to the investors. Permission to trade. As per SEBI guidelines, companies have to complete all the formalities within 7 working days of finalization of basis of allotment. A company should do allotment of all securities and related work within the time frame given. It should obtain the listing permissions of all the exchanges whose names are stated in its prospectus within this time limit. In case of denial of listing permission by any stock exchange, it cannot proceed with allotment of shares. However, the company may file an appeal before SEBI against the denial of listing permission. Requirement of security amount. Company seeking listing is required to deposit 1% of issue amount as security to stock exchange before the issue is listed for trading. The amount may get forfeited in case of company fails to resolve the complaints of investors regarding share certificate or any other issue related matter. However, after the demat trading being in vogue, the problem of refund orders, share certificates delay has been put to rest. All companies listed on the exchange have to pay annual listing fees for their continued listing for trading on the stock exchange. Compliance with the agreement. The listing department monitors timely payment of fee, observing company whether it is adhering to rules and regulation regarding minimum number of shareholders, etc., and taking penal action against defaulting companies. Types of pricing methods in IPO. There are two types of pricing methods in IPO. 1. Fixed price. 2. Book building. Fixed price. In this method, price of the share is fixed and securities are offered at this price. Price is made known to investors in advance. Investors' demand of the shares is known only after the issue is being closed. The investors have to pay 100% money on application of the share. Book building. Book building is used in initial public offer, IPO, which helps in price and demand discovery. SEBI introduced this method for greater transparency in price determination, which is beneficial to issuing company as well as to investors. It is more suitable for big issues, though minimum size is not fixed by SEBI. In this method, bids are collected from investors at various prices, which are above or equal to the floor price. The offer issue price is then determined after the bid closing date based on certain evaluation criteria adopted by the company in consultation with the merchant bankers. SEBI guidelines for book building. Companies have the option to issue securities through book building or fixed price method. There are certain guidelines by SEBI in case company chooses to issue securities through book building route. In the book building method too, there are two ways the company can come out with the public issue. A. 100% of the net offer to the public through the book building route. B. 75% of the net offer to the public through the book building process and 25% through the fixed price portion, followed after the 75% of the issue has been made. In this method, company first discovers the price by offering 75% of the shares, then it is followed by the issue at the discovered price. Source: SEBI website. The process of book building. Book runner is being appointed by the company, who is the lead merchant banker, along with the syndicate members comprising of brokers with whom the investors can place orders. The price band is specified by the issuer along with the number of securities and the period till when the bid is open for public. Process called bidding is initiated, which is similar to open auction, wherein syndicate members record the orders in electronic book. A book remains open for a minimum of 5 days for capturing the response of the investors for the price at which they are willing to buy shares. Bids cannot be entered at less than the floor price. Bids can be revised by the bidder before the issue closes. The book runner evaluates the bids on the basis of criteria as mentioned in the prospectus, which may include price, promptness of bids, etc. Final price is concluded after the closure of bid and evaluation by the book runner and the company. Types of investors: 1. Retail investors, 2. Non-institutional investors, 3. Qualified institutional investor. QIB can be mutual funds, foreign institutional investors, banks or insurance companies. Now look at this table: issue type, offer price, demand, payment, reservation. In case of fixed price issues, price is known to investor in advance and is fixed in nature. Demand can be known only after closure of the issue. Advance payment of 100% is required at the time of issue. 50% of the shares offered are reserved for applications below rupees 1 lakh and the balance for higher net worth investors. Under book building issues, a 20% price band is offered by the issuer, within which investors are allowed to bid, and the final price is determined by the issuer only after closure of the bidding. Demand can be captured by exchange on real-time basis. 100% advance from investors, barring qualified investors from whom only 10% is required. 50% of the shares offered are reserved for QIBs, 35% for small investors, and the balance for all other investors. Source: bseindia.com. How are shares allocated? As per SEBI regulations, retail investors get at least 25% of the shares on offer and 50% is kept aside for QIB. If any of these categories is undersubscribed, say the retail portion is undersubscribed, then that can be allocated among the other two categories at the discretion of the management. Summary. Let's recapitulate. 1. Capital market is a very important segment of financial market. Capital market performs a number of important functions. These are mechanisms which facilitate the transfer of investable funds from financial surplus units to financial deficit units, that is, from savers to investors. 2. Financial markets are divided into two parts: capital and money market. Capital market is a market in which funds are raised for longer period. It has two components: primary or new issue market and secondary market. 3. The primary market is the market where the securities are issued for the first time to the public. The issue can be shares or debentures. 4. Secondary market is the term given to market where buyers and sellers come under one roof and trade for securities which get listed on a stock exchange or securities which have already been issued in the primary market. 5. Methods of issuing securities in the primary market are initial public offer, IPO, follow-on public offer, FPO, private placements, rights issue for existing companies. 6. There are certain statutory requirements which every company needs to follow before going public. Companies have to make regular disclosures about their working in addition to a prospectus issued at the time of going public. Prospectus is issued when companies float capital in the market and contains information about owners, project, market of the product and capital structure, etc. 7. Two types of pricing methods: an initial public offer, book building, and fixed price method. Process used in issue of capital from public in initial public offer (IPO), which helps in price and demand discovery, is called book building. Fixed price is a price which is known in advance and is fixed. SEBI plays a crucial role in regulating the new issue market, primary market, for safeguarding the interest of the investors. It has made various guidelines to ensure proper disclosure and investors' protection. Thank you.